quick question. I just want to see who here's heard of iNovia. Come on. Come on. That's it.
At the back, who heard about iNovia? A few of you said, when is the iNovia panel? So I know.
Okay. Well, I'm surprised. I thought they're probably the firm with the most name brand recognition in Canada. But so iNovia actually has two funds. It was started off as I guess a venture fund, and Alex is part of the growth team or growth fund.
Yeah, that's right. There we go. That's better. We actually have 9 funds. We have 9 active funds, and we have 4 different strategies. A great way to start is correcting you.
Great.
Yes. Sorry about that.
No, I love being corrected because
Yeah.
I wouldn't have known. I should know that myself.
No, we invested out of one of our funds in your fund.
Well, that's a fund of funds, but
okay, I'm counting it. So we have a pre-seed fund that's based in the UK.
Oh, yes.
We have the Discovery Fund, which is our fund-to-fund strategy. We invest in emerging managers like Alex's fund, and then we have our venture fund and our growth fund.
That's not 9.
Well, we have multiple funds within those strategies.
So I should have said better if I said better if you have multiple strategies.
Yes. Okay, now we're finally on the same page.
Yes, multiple strategies. And I keep on forgetting about Rafe in England.
Yes, exactly.
Okay, so now that I've embarrassed myself, Alex, why don't you introduce yourself? Tell us about your background and how you got into venture.
Yeah, for sure. So I have definitely atypical background because I've sort of done it all in a relatively short period of time. So right out of undergrad, I was in investment banking in New York. I was on the communications, media, and entertainment team. I did a lot of large cap entertainment and broadcasting. Subsequent to that, I went to a private equity fund based in New York. It's called ZMC or Zelnick Media Capital. It's $46 billion fund, and it's divided into 2 arms. Number one is managing Take-Two Interactive, which is the gaming publisher that makes Grand Theft Auto and 2K games and Rockstar Games and a bunch of titles that I've never heard of or never played before, rather. And the other arm is the private equity business, and that's where I sat. And as I said, it's called ZMC, and the M is media, and it's media very broadly defined, and the definition gets broader by the day. So we did pure play media, but we also did digital health and e-commerce enablement and really things that had nothing to do with media. But I spent a lot of time doing pure play content. And in February of 2021, we invested in a business that you might be familiar with. It's called Second City, and it's a large comedy institution that's a lot larger than people appreciate. And it was a walkaway deal. The founder and CEO left with the after the acquisition, and we needed a leadership stopgap until we identified a CEO. So I went on a 2-year secondment, worked with the CFO and COO, and had an opportunity to really get my hands dirty and work with a company in a significant time of transition, and also professionalize a 62-year-old business that never had a budget process and where people had been making the same salary for decades. So great experience. Ultimately, I was supposed to go back, but conveniently, iNovia was hiring at the same time, and I was ready to come back to Toronto, where I was born and raised and where my family was, and didn't love the prospect of raising a kid in a 400 square foot apartment in New York. So came back, joined the fund. It's been a really great experience. The team is awesome. It's really nice to be back in the investor seat, and it's been over 2 years now.
I want to comment that New York, you get 400 square feet. You can come here and get 600 square feet instead. Yeah. So you get the Canadian conversion.
Yeah, right.
So why iNovia?
So I think there's 3 things that are particularly unique about iNovia that attracted me to the fund. Number one, it's full stack, as I mentioned. So pre-seed to pre-IPO, we can engage with a company at multiple different stages of its life cycle, and we have done so. So we've backed companies out of our venture fund and then doubled down in our growth fund. And there's countless examples, Spare, Super, AliCare, Benchside, those are all Canadian companies. And even though I'm on the growth fund, I get to work with our venture team if I have domain expertise in a company in an area that they're looking at, which has been great. I think the other thing that really attracted me to the fund is that the partnership is largely made up of very sophisticated operators. So the partner I work for, Dennis, was the CFO of BlackBerry for 15 years. The other partner on the growth fund was the CFO of BlackBerry. We have the lead of Google Canada is one of our venture partners. So they really understand how to build businesses, what our founders are going through, and really can empathize with their success and their challenges. And the last bit is, I think something that's really value and unique to iNovia and makes us very credible is the platform team. So we have the ability to advise our companies across M&A, both sell side and buy side, marketing and comms, product, and talent management, which is a pretty unique value proposition. And we're very serious about actually deploying that help. We want to be the first call you make when you need the support of one of your investors, and that usually is the case.
So I love that. You have a full stack from the beginning to the end. You can finance a company. You have a team that knows what they're doing, and you have the ability to help.
Yes,
So-
that was a very good way to put it.
No, but-
in
well,
a
I'm
much shorter
You know,
than
I,
my
I,
ramble.
I'm like granola. I can just summarize it.
Okay,
Yeah. So for people that don't understand, like, when does your fund invest versus the venture fund? So what makes a growth round?
So growth, which is the team that I sit on, we usually invest when a company's at $10 million of ARR plus. So it's Series B plus. We're looking to back companies that are not in the exploration phase. They're founders that are ready to scale what's working. You can think about it like this analogy that I like is the engine is built and we are ready to help you floor it.
So is it just revenue, or is there something else that indicates that the engine's working?
Oh yeah, for sure. So I think something that makes a company qualified for a growth round is that you've established product market fit and GTM or go to market repeatability. So you're not typically going to growth rounds. Yeah, it's a lot. You're raising a lot of cash, but it's not just about a lot of cash. It's about backing a company when they're no longer in the experimentation phase, when they're ready to scale what's working. And because of that, growth investors have very different expectations than venture investors. We're looking, obviously, to support the vision of the founder, but we're also looking for metrics. We're looking for dashboards. We're looking for operational maturity. We're looking for signs that this is a well-oiled machine or has the path to being a well-oiled machine, and that we can help you scale that as efficiently as possible.
So is it a mix of quantitative and qualitative? Like, for people in the room that are people that might watch this video later, what is it that you dig into?
So yeah, we're very metrics oriented, and growth funds typically are. We'll look at your ARR. Typically, growth funds will engage when you're at or at least at Series B, when you're at 5 to 15 million of ARR. You have that go-to-market engine. You have your company is growing and probably growing consistently year over year. And then also we want to see that you're starting to look like a more mature business. Like the talent bench is growing. You're putting in the proper infrastructure to help support the team. And ultimately, it's sort of sound like a broken record, but you're no longer searching for your what's next or what's going to work. You've established that this is the product that's resonating with the customers. This is how we reach the customers, and you're on the path to being a success.
I'm going to ask a question I know will come up. Is there a certain market size or return you're looking for? So someone has all that. Is it okay if they can double, or is it they have to have a massive market? And how do you judge that?
So I think like our return expectations are very different depending on the size or the stage of the business. The partner I work for says at the Series B, he doesn't get out of bed for anything less than a 7x. That's a little aggressive, but I think as the company matures, the return expectations become lower. What was part two of that question?
So yeah.
Yeah.
Like, how do you judge that? Like, if you're looking at 7x at B, like, is it just market size? Is it, hey,
Well, I mean, it really depends on which partner you talk to, but we are looking for companies that are, if they're early stage, they can have a smaller market. And the idea is that they capture as much as that market as possible throughout the hold period. At the later stage, in order to get that 2x return pre-IPO, we probably need to see a pretty large market that they can grow into.
So let's go a bit into that early stage growth versus late stage growth.
Yeah.
You mentioned Series B, you mentioned Series D.
Mhm.
Most people think, oh, there's just letters, and you hear companies raising, God knows what series. But so, what's the difference between a B and a D in your mind?
Yeah, so it's not just letters. There's different expectations. Series B companies are again like between that $5 and $10 million ARR range. They are showing consistent growth. They have established product market fit. They probably have one efficient go to market channel. They and typically the use of proceeds from that round is going towards scaling what works. Series D plus companies are considered later stage growth, and those companies have a clear go to market engine. They're probably pursuing more than one channel to acquire customers. They're well beyond product market fit. They probably, they could actually have customers that look a little bit different, and as they've been able to tap into new verticals, they have like visibility into profitability, and usually the capital raised at the later stage is used to accelerate product or expansion, geographical expansion, M&A, or pre-IPO preparedness.
Interesting. So you've got a lot of stages, or growth companies can look very different.
Mhm.
So when you talk to founders, what's the biggest mistakes you see when they come talk to a growth stage? Because how do they mess it up?
Okay, so I would say the most important, well, there's actually a lot of dimensions to this, but you need to know your story. So have a good understanding of what you're selling, how incremental capital is going to help you accelerate your growth. Know that growth funds are not focused on the vision. Obviously, they want to support the founder and their vision and pursuing the path that they want to and the opportunity they want to, but we are very metrics and numbers oriented, and you don't want to come in with a vision deck. You want to come in with a view of your dashboard. I would say raising too early is sort of an issue. You need to make sure that you have your metrics there. You can think about growth capital. It's like it's glue. It's gas. It's not glue. Like you can't. We're not looking to help you piece your company together. We're looking to help you, again, like floor it. I think having a really good understanding of that is very beneficial going into a round.
So it sounds unlike a pre-seed round where someone just can put a deck together, just like preparation for this. Like, so how much far in advance should someone be preparing? What should they do to lay the groundwork to go raise a growth round?
So iNovia's strategy is to develop relationships with companies well beyond their raise. And obviously, you don't want to spend your entire day talking to investors, but you definitely want to start engaging really early. So say 12 to 18 months out. It takes a while to establish that trust and decide whether or not you want to partner with a fund. Like you're not going to marry someone you met a month ago. And you need to be comfortable with waking up. Well, hopefully not waking. Waking up to next to that person every day. You want to make sure it's the right person to help you scale the business. So go out and have those conversations early. Make sure you start tracking your metrics early and track the metrics that growth investors actually care about. So gross dollar retention, net dollar retention, CAC payback. That's what we want to see. And again, know your story and be able to articulate it.
And how do you determine valuation dilution?
So from my perspective, and this is very much so easier said than done, but I would rather take more dilution if it means having the right partner with the right terms and working with someone who's going to let me manage and grow the company the way I want to. It's obviously super attractive to minimize your dilution and have a huge headline value, but sometimes that comes with terms that end up handcuffing you, and it could even backfire and limit your optionality. So from my perspective, in the long term, it's better to establish a partnership with a fund that can help you actually scale, even if that comes at a lower price.
So there's actually two things I like to break down there. First, I'll start with the right partner.
Yeah.
So how do you know it's the right partner? Is it their thesis? Is their experience? What should someone be looking for?
So the right partner is going to look different at different stages of the company. So Series A and seed, you're looking for someone who really understands the vision, can help you establish product market fit, can help you define what channels are the right way to access your customers. Series B and C investors, you want people that understand how to scale, how to basically further operationalize your business, build out your executive bench, put in place the right infrastructure. And then Series D plus, that's about governance, that's about executing on these more aggressive growth strategies, or I guess inorganic growth strategies like geographical expansion, product expansion, M&A, and then preparing you for uh, exit.
And so I just want to go a bit off schedule. There's one thing you mentioned there about terms.
Yeah.
So I think my guess is you're always taking a board seat when you invest,
Yeah, we typically take a board seat.
right? So most founders early on, what this whole ecosystem gets focused on is how much is raised and what's the valuation.
Mhm.
But you mentioned you're going to be a board member and you're going to do terms. So what are the typical trade-offs? Like there's a saying I've heard, your price, your valuation, my terms, your terms, my valuation. So like, what are the terms trade-off that people should be aware of? Like, that might be getting to get a valuation that might be a headline crazy.
Maybe something comes at a really expensive price and you have warrants in place. You have a ridiculous liquidation preference. So basically what they're doing is putting an instrument in place that makes sure that they get their return regardless or if whether this is a success story or not. A lower valuation might come with like cleaner or more friendly terms where because they're not pricing it at a massive premium to where the market would probably price the asset, the terms are more friendly to the founder.
Cool, because I think it doesn't get talked enough about in this market. Let's talk about, you can go back 4 years, ZERP, everyone was raising a massive growth round.
Mm-hmm.
Seems like there's less now. So what's reality in the ground and how's it changed in the last 3-4 years?
So the bar is much higher, and I think it went from when there was tons of liquidity in the market and everyone had access to capital and everyone had huge budgets to deploy in very discretionary ways. You were pursuing a growth at all costs strategy. Now it's growth at no or low cost. Like it's the capital is there. We just need to see some efficiency or profitability in order for us to deploy it in your direction.
Cool. And then one other thing that gets talked a lot about is secondaries. And then we seem to have seen a lot recently in Canada. I think Jane just took a secondary, Stack Adapt. I think Clio. Why is this happening now instead of like such late stages? And when should founders think about taking a secondary?
So just in case anyone doesn't know, secondary is when instead of a primary capital is when you fund the balance sheet. So you're giving a company more cash. Secondary is when you're buying existing shares from an existing investor. So we're seeing a lot of secondary activity now because companies are staying private for longer. Maybe a company has hit its milestones and a founder, an existing investor wants to de-risk, or because investors want to put a large amount of money at work, but they don't want to overcapitalize the business, and doing a combination of primary and secondary is a good way to balance that.
Cool. I'm going to ask one more question before we go to the audience. We're in Canada.
Yeah.
What, you had experience in New York, so you understand both markets. What's unique challenges for getting a Canadian company, when a Canadian company gets to 10 million revenue? Like, what do you think is harder, easier here?
So, I mean, the population of Canada is just over the population of California. Like that comes with unique, I mean, you all know that comes with unique challenges. And I think one of them is talent density at scale. So often what you see is companies have to look to the US to fill out their executive bench. We have a number of portfolio companies that have done exactly so, tapping into the US talent pool for CFOs, COOs, etc. Another difficulty, I think, is that there's very limited growth funds in Canada that are able to write $30+ million checks. And iNovia is one of them. Georgian is another. Radical now has a growth fund. But as a result of that, you have to appeal to US investors, and US investors want to see that you can grow cross border. So it's really important that you have a US pipeline or US customers. Any indication that you can grow beyond Canada becomes really critical.
So I want to just have a follow-up question there before we open the audience. So grow beyond Canada, does that mean one customer, 10% of business? Like what's the validation? Is it like
We just looked at a company that had a very successful round where they kind of topped out the Canadian market and all the growth was coming from the US. And we didn't see, because of that, we didn't see a lot of product market fit in the US. We didn't know if there was truly a market there. So we need to see, I'm not going to put a number on it because it really depends based on the business, but we need to see a pretty meaningful portion of the business being in the US to validate whether there's actually a market for your product there, especially if there's competition that is in the US that it might be much more expensive to acquire US customers if that's a saturated market.
cool? Let's go to audience. Marie, do you have a first Slido?
I'm just going to ask you one of mine. What's your
For it.
favorite investment?
Okay. Well, I think my favorite investment in the iNovia portfolio is actually a company that both Alex's fund and iNovia invested in, or our fund invested in, which is Spellbook. Spellbook is a chat. Basically, you think about it as ChatGPT for lawyers, but it's much more sophisticated than that. It's not just a wrapper on top of ChatGPT, but it's a breakout Canadian story in the AI space, which is a perfect company for iNovia to back. They're growing quite incredibly quickly, and they're very scrappy. They've been able to grow incredibly efficiently. So, and they've attracted a number of US investors as a result. And that will be an amazing outcome for you, and it will be a great outcome for us. Plus, one of the founders is a very good friend of mine. So it's great to see him be so successful. At my prior fund, the best investment we made was Second City. I mean, going to that company was amazing. I got to work for Stephen Colbert and Steve Carell and Tina Fey and like people that I really admire. And that's because we wrote a check. So it's cool to be able to have access to that talent pool when you just dangle a pretty attractive carrot.
What is one vertical that you wish people were building more in Canada?
Entertainment. Yeah, I mean, just selfishly, I think it's really hard to build an entertainment, especially in Canada, because I hope there's no actors in the room. Can you just identify yourselves? But the industry just doesn't exist to the same degree as it does in the US, and I have my reasons for that I won't bore you with. But I do think there's a lot of opportunity there, and I'd love to see somebody build something disruptive in that space.
Can I just ask an adjacent question to that?
Yes.
Like, because Canada's in lots of special effects and After Effects, and there's a lot of technology there.
Mhm.
Is that industry get decimated by AI?
It's a really good question. I don't really have a thesis on that yet.
Okay.
I'm working on it, but I think as long as there's a creative process, I don't know. I kind of go back and forth on this, but there's a reason that the Writers Guild was on strike for an immense amount of time. People feel the threat of this, and I think it's going to be very difficult to disrupt the creative work, but there are certainly ways to augment the creative workflows. So sort of same with Spellbook, right? Spellbook is not out to take the jobs of lawyers. They're out to make lawyers work more efficiently.
Cool. Marie, any more?
These are all mine, by the way.
Yeah.
I-
People are getting.
okay.
It's been a long day.
It's been a long
tired.
day, but I have one biggest biggest pet peeve from like a founder coming to you.
It's like approaching on the street.
No, like
How you doing?
that would be bad. But like, is there like a faux pas for approaching investors? Maybe there isn't.
No, there are.
Okay.
There
You're
are. I
picking
just don't
which
know.
one.
I just don't know what I want to
Picking which one. And Alex, you can answer too if you're up to it.
I don't know how savage I want to be at this stage.
Very
It's okay. We won't record it. So
Okay.
let's take it out.
All right. Spill the tea. I don't know. It's a really good question. I had something today where it was just like this very entitled founder that, and I didn't like him from the start. I knew I didn't like him. He just talks about there was no humility in it. He's Canadian. I was shocked that there was no humility there. He's like, I built. First of all, he gets on the phone. Now I'm gonna rant. He gets on the phone with us, and he has no idea who he's talking to. Like, make sure if you're talking to a fund, do a little bit of background research. Know, like, just like how we would do background research on your company. Spend, it doesn't even have to be 30 minutes. Just spend 10 minutes finding out what we work on. Because this kid he's a kid. He's younger than me. Anyone younger than me is a kid, and I'm not that old. I promise I'm not that old. He gets on the phone. He's like, "Oh, I want to work with a Canadian fund." I'm like, awesome. That's great. You're doing an application of AI. Do you know that we invest in Cohere? Do you know that we invest in all these other things? It was personally offensive. However, that's just me. Don't be entitled. Also, I think it's really valuable personally if you respond to emails, even if you just tell people politely to F off, politely, and not using that exact language. But these are people that eventually A, they might want to give you money, but B, you'll want to keep on your good side, even if it's just so you can exploit their talent management platform. So I would just respond to emails. It's kind of annoying when I'm like easily.
This was a good question.
This is a good question. Now I'm getting like agitated. Good thing we're going for drinks after this.
Well, I want to jump on this because it's been a long day too. So there's two things I'll give you. One is some founder, like, look, I try to respond to everyone, but I don't know. Marie knows what my inbox is, and I've had people reach out to me first, do an application on my website, then do an email, then text me, then LinkedIn message me, then WhatsApp me. I'm like, if you go through 6 different channels to get to me, all you're doing is
talk to you.
what?
I probably don't want to talk to you.
Yeah, I don't want to talk to you this morning. Like, it's like, what are you going to be as a partner? And I think I'm a bit more responsive than an average person. So that really pissed me off. The second thing, which I've seen now happen a few times, is people like have a good conversation with me, and I don't know if there's someone coming in, they start telling other people I'm leading around. That gets back to me right away. And if I haven't had any indication I'm leading around, that's just like chance of me investing you now is almost zero. Like, you have to be fucking good, and I have to be like, but like, and it's happened to me 2 or 3 times where I get, especially like go to Americans, and I guess I assume I don't know, and they're like, I don't know what the benefit is, but I've had people say, yeah, I talked to Alex last week. He's going to be putting a term sheet in, and like, the market is small. Don't lie. There's a difference between saying, oh, I've talked to Alex, he may be interested, and oh, Alex is leading around, and that just like, I don't want to do business with you ever again.
Yeah, it's interesting because we're in very different positions. Like, people are chasing your capital. We are trying to put our capital to work, and we're going after like tier 1 companies. So it's a lot more outreach. We're doing a lot more outreach, whereas I'm sure getting a ton of inbounds. So for me, it's when I reach out, please respond to my emails. I would really appreciate that.
I'll say one thing that pisses me off about late stage too.
We're gonna keep.
No,
going.
it's no. It's like
we got the Benny Hill
the Canadian founders that go, oh, I want to be pro Canada and stuff like that. They go talk to like the growth funds here, and then I know to get a different, less valuable valuation. Like, they block the Canadians out and say, oh, we're all pro Canada, and no one will invest in us. I'm like, well, that's not necessarily true, and just it's bullshit.
Yeah, especially when they have an elbows up sign as their like LinkedIn cover. What are those called? Like the headline photos, elbows up. No, you don't know about this?
That's
okay. Everyone go look at elbows up. That's the Liberal campaign for buying Canadian and all that jazz. What was it? Mike Myers did elbows up on SNL. Does anyone watch SNL here?
Of course.
Okay, yeah.
Mike Myers does look very old.
He does look. I know. People age. It's really unfortunate. Yeah.
This is really good.
Any other question?
Has questions. Oh, they're now they're awake. All right.
Thanks for the presentation, guys. It was very insightful. My question is, um, was there ever a time when you were investing or looking at data, um, you saw a horrendous cap table?
Oh yeah,
And
for sure.
and
Yeah.
and how would you define that?
Okay, I can think of it two ways. Number one, you've raised a ton of money and you've raised really, really small checks. And sometimes that's a good thing because there's an opportunity for us to come in and clean up the cap table. But what's more offensive is when there's a bad fund on there, a fund that is really aggressive and maybe doesn't have the best reputation. Like, you got to be really careful when you're picking. As I said, you don't marry someone that you've only known for a month. And if you do, good luck. You want to work with really good partners, and maybe that looks different based on what you're building and what stage you're at. But there are some funds that have really good reputations, and then there's some funds that don't. So be really careful with who you decide to partner with, because that might turn off some really good funds.
And I'll give the early stage and what I've seen. First of all, if you have great metrics, that's definitely overcomable. If you're on the borderline investments, it's an easy reason for someone say no. I think the bigger mistake, which I see founders at early stage walk into, is they get a broken cap table because they don't have founder vesting. And so you've got a company, you started out 12 months, like 11 months in, one of the founders leaves with 35% of the cap table. And then you go to raise that A, and it's considered dead weight. And you need, so that's why when I invest, I always recommend reverse vesting. And everyone's like, oh, you're just trying to save yourself. I'm trying to save the company. And so I've had a couple times early on in my career where we had to, like, founders basically broke up, and we had to figure a way to get a contract in that breakup so we can clean the cap table up, because otherwise the company's dead. No founder coming to Series A or B wants to see 35% in a founder that hasn't been there in 3 years. Or am I wrong with that?
No, I think that's exactly right. Ooh, that's a good question. Well, I want to invest in your company. So I'm going to need you to take the valuation that's going to give me that 7x. No, I think obviously the return expectations are going to change based on your stage, but we're not going to put you in a position where you don't have an ownership stake that is meaningful for you. Like, the worst thing possible is to have a series. Well, not the, I mean, it's very dangerous for a founder not to have skin in the game and not to have a path to material upside. We want to make sure everyone's aligned, so we're not going to squeeze you and give you a really bad term sheet so that we can get that 7x. It's just not mutually advantageous.
And I'd also say what I see with late stage, and I talk to my founders about this. Again, what I said is you can get the terms or the valuation. And so sometimes maybe if they want to be a firm wants to be in a hot deal and they're not sure about the 7x, they'll put a 2 or 3, 2 times liquidation preference and a bunch of control in there, so they limit their downside, right? So there's a bunch of ways to structure a return that may meet their needs without being an explicit 7x.
Mm-hmm.
And my advice is don't do that.
Yes. Yeah.
One more, last one.
Exactly.
So there was a lot of qualities describing founders. It's an organic journey that led them to that, and then they looked for initial investors that were in that industry or understood that niche. And then ideally, the company also went through an incubator that led to, their first seed, Series A, etc. Is there other like green flags like that are kind of like, oh, this story makes sense all along the way that leads to higher success with further rounds?
That's a really good question. You want to go first?
Green flags are weird because, like, it's usually red flags I'm worried about. And, like, the truth is many of my best early stage investments are not doing what exactly they said they would do, right? Like, so, I think at the early stage, you're looking for the right team and the right team for the right opportunity, and a team that seems to think on their, like, what I find is the most common thing is founders that can execute quickly, work with ambiguity, learn quickly, and be tenacious. And I think the later stage, it comes down to, like, does this story make sense? even if they have, like, again, if you have the right metrics and the right story, like, I think even if you have the wrong investors, um, I think I think the other, sorry, and I'm rambling here, but myself, the other thing I think that really looks good is when you have a team that's a really kick-ass team a couple levels down, and everyone's mission driven. They don't appear to be mercenary. There's no turnover. Because a warning sign to me is when a company has a lot of turnover, even if they're growing. Because if you're in a fast-growing company and it's kicking ass, the team should be excited and staying.
Yeah, I definitely agree. And one thing I'll add, because I'm at the later stage, is seeing funds that have continued to invest throughout the rounds. Like if you have a seed investor that wants to get in the A and the B and take their pro rata, that's a very meaningful signal, especially if that's a fund that you respect. I would say the other one is attracting really great talent. It's very meaningful if you can poach. I mean, ideally, you're not poaching from a competitor, but poaching talent from a really reputable name is a very meaningful signal.
It's funny what you said about investing. I'll go, there's a red flag. Like, there's a couple companies, again, I'm not set up to do multiple stage, I can do SPVs, but if it's a good company and I believe in it and I've been there longer, I want to put more money in and I'll try to find a way. There's a couple companies in the ZERP era where I'm like, these guys are gone, hey, I got to get the fuck out of here. And no one ever thought of asking me because the market was going so fast. But like, if you have an early stage investor that's can't believe a round's being done and they want to dump their shares, that's usually a bad sign.
Yeah, what's that platform? Was it Hive, that platform that is secondaries for privates? Yeah, check and see if those shares are available there. Not that it's all garbage there, but absolutely not. But it's like if you have funds that want to monetize their stake and they haven't, like, think about look at the other signals and see if that's confirmatory of anything.
Yeah, and
it's not going to be your only signal, but maybe that's confirmatory.
Like, I'll take some secondary along the way in my best performing companies, but I don't need to go to Hive to do it.
Nice. Yeah.
That concludes us really well. Thank you so much, Alex, for being with us.